The equity markets in 2018 have been very, very interesting. As we talked about earlier, they were up big, they were down, they rallied. And so as we end the first half of 2018, the S&P 500 is slightly above break even, as we can see on this chart. However, this has been an extraordinarily narrow market. In other words, the number of companies that are actually generating this positive return are very, very small. The broad markets, and more importantly, the high quality markets, actually are down. And so it's an interesting market. It's a frustrating market for investors. You look at the S&P, you say, I should be up 2%. And you look at the broad markets and they're down, and it's hard for investors to wrap their heads around that. So let's look at some of the details around that, because that also indicates to us there's opportunity in the market. As we can see on this chart, we just talked about the NASDAQ, the Russell 2000 small caps doing quite well. There's the S&P 500 barely up, all the international stocks down. But the second group, the green lines, you'll see the differentiation in returns. Growth stocks are up this year. So large cap, mid cap, small cap growth stocks all up. But what we'll see is large cap value, the traditional high quality names, dividends, the names we all like to own, they're actually down this year, year to date. So we do have this bifurcation in the market between high quality and low quality, between dividends and non-dividend payers, and we're seeing the market on the higher quality side down. And as we talked about earlier, you can see that in the different sector distributions. Now, how narrow is it? This slide is very interesting, and the opportunities to take advantage of this kind of market come once every few years. This next chart shows the return contributors for the S&P 500 year to date. And this is fascinating. These are the top 10 returners in the S&P 500 for this year. And what we'll see is, here's your names: Amazon and Netflix, Microsoft, Apple, MasterCard, Adobe, Facebook, Visa, NVIDIA, and Fox. What's interesting about it is, look at the far right column, you'll see their contribution to the S&P 500. And if we go down to the bottom, here we'll see these top 10 contributors contributed 121% of the return of the S&P. In other words, 10 stocks are all of the return plus a little bit. The other 490 are down. This is the definition of a narrow market. 10 stocks driving the entire market return and the rest of the market struggling. So how do we take advantage of this situation? The answer is, and always is, fundamentals. So let's take a look at the fundamentals of the market. On this next chart, you'll see earnings growth estimates. And so this chart looks at 2019 growth estimates for earnings. And it's what we would expect it to be. The growth-oriented names have the higher earnings expectations, and the value-oriented names are at the bottom end of the chart. So where's money going to flow? It's going to flow to all these exciting earnings growth estimates. Now, the question, though, is there a circumstance where analysts kind of get ahead of themselves? They get so excited about the market, and the market keeps going higher and higher, the same names, and they're trying to justify price targets that are going higher, and they start to get out ahead of themselves. The answer is, of course. Earnings estimates get a little too exaggerated. So what happens is, as new estimates come out, the momentum of those growth numbers starts to slow. And we can see that on the next chart, the earnings momentum. The growth estimate momentum, or in other words, these upswinging expectations, are actually slowing and getting weaker in the growth markets. Where are the earnings estimate momentum starting to go up? The answer is value. So we have our first fundamental piece, that earnings estimates are high, but the momentum in earnings growth is actually with value, and yet those stocks have not performed nearly as well. On the next slide, you'll see valuations. And this is no surprise. The most expensive names are the growth names: small growth, mid-cap growth, large cap growth. These names have exploded this year, and they've really separated themselves from value. That tells us there's opportunity. We have to be concerned about overvaluation in one pocket of the market. But to create overvaluation, you have to pull capital away from other areas in the market. In this case, that's value. And as we go to the right side of the chart, we'll see the least expensive names, small cap value, mid cap value, and large cap value are all on the right side of the chart. So opportunity exists. Valuations are lower. Earnings momentum increases are higher. That to us sounds like a place where we want to put money. Should we stay home or go abroad? This is the basic question between investing in the U.S. or investing internationally. And so this first chart shows the rate of returns on U.S. stocks, which is in the blue, and international stocks in the orange. And we can see they've stayed relatively correlated since December of 2017. But just recently here this year, we've seen the separation where the U.S. has gone up slightly and international stocks have not done nearly as well. Again, that gap to us says that's something we need to look at. Is there opportunity there? In of itself, just because they're underperforming doesn't mean it's a buy, but it's definitely something we want to take note of and look at valuations. So when we look at valuations in the international market, we get green lights. This first shows valuations of international stocks versus U.S. When the chart goes above the dotted line or the average, that says U.S. stocks are more expensive, and that tells us international is a value. When it's below the chart, the reverse is true. Well, if we go back and we look at some of these specific points of time, we know that back in 2002, where this chart is very low, U.S. stocks had crashed. It was a great time to buy U.S. stocks, and sure enough, they took off like a rocket. And so back in 2007, when the U.S. was hot and everybody was enjoying this great housing market, U.S. stocks got expensive. International outperformed the next several years. So the chart has held up relative to valuations versus performance. So we do take note that we're at a high level again on the valuation. So going back to the original comment about this year's market, we have a bifurcated equity market. Money is flowing to a very narrow pocket in the market, and when that happens, we need to make sure that we understand that there's opportunity somewhere else. And what we know is that this trend can be very frustrating for investors. Now, traditionally what happens when we get these very narrow market advances and the rest of the market is lagging behind, the summer months tend to exaggerate this phenomena, and that's where we see peak investor frustration. As a matter of fact, August, for whatever reason, tends to be the peak of that. That's usually followed by volatility, often in the fall, that September, October timeframe, and that's where the markets start to break out and the broad markets recover. Now, we're not predicting that very specific pattern. That's just traditionally what we see, but we want to make sure that you as an investor are aware that this phenomena, this very narrow market, it can't last forever, and what usually corrects the pattern is more volatility. So be prepared. How extreme is it? Well, what we look for in the equity markets is how far apart from the norm are these trends. So statistically, with a 1 standard deviation move away from the norm, that's significant. That's something we want to pay attention to, and in fact, we may want to invest into. When you get to a 2 standard deviation event, that's a once in a decade or more event. When you get to 2 standard deviations, you have to take note. You have to make sure you're acting in the portfolio because the reversal of 2 standard deviation events are actually pretty significant. So the obvious question, do we have 2 standard deviation events in the market? And I would point out one other quick item. When we get these narrow growth-oriented markets, what's also true every time is it feels good. The economy's good. Growth stocks are going up. The S&P's higher. People just feel like everything's okay. The reversal is actually sometimes unexpected. So let's take a look and let's again rely on the fundamentals. Do we have standard deviations of 2 or higher? The answer is yes. And in fact, we're seeing more of it than we have seen since 2000. So this next chart, large cap growth versus large cap value. The orange line is a 2 standard deviation. There it is. We've hit a 2 standard deviation. Haven't seen it since 1999, which was the precursor for the tech bubble burst. Mid-cap growth versus mid-cap value. 2 standard deviation spread, growth is more expensive than value. Small cap growth versus small cap value. 2 standard deviation spread, again, small cap growth, tremendously more expensive than small cap value. International stocks versus U.S. This is the Russell 1000 versus the MSCI All World, excluding U.S. 2 standard deviation spread. International stocks that much cheaper than U.S. So we want to make sure that we understand moments like this in time don't happen that often. This is a time to make sure we take advantage of that, pull money away from where we see risk and overvaluation, move money where we see opportunity. Where is it? It's value, it's international.